In the past few hours, silver didn't just rise, it snapped. It blasted through a price barrier that once felt out of reach, and it did so while something even more shocking unfolded across the globe. In Asia, physical buyers began offering massive premiums that traders in the West can't ignore much longer. That's the real headline today. Not next month, not someday, now. Physical pricing is beginning to yank the paper price upward like a dragged anchor. And if you've been waiting for the moment when the two markets stop pretending to reflect the same reality, you may be witnessing it happen live. So in this video, I'm going to unpack what just occurred, why it unfolded the way it did, and what it could mean for anyone holding silver, watching gold, or wondering if mining stocks are about to erupt. Also, we'll dig into the strangest risk to your silver that might be hiding in plain sight, inside your own house. Sounds funny until it's not. We'll get to that in a bit. But first, something quick but key. I'm launching a campaign to push back against clone channels stealing this work and diluting the message. If you respect what I do, hit subscribe and drop OG John AG in the comments so I know who's riding with me for real. And one more thing before we dive into the charts. If you want fast updates, short posts, and my raw market takes that don't make it to YouTube, plus real-time voice notes when things break, I created a WhatsApp channel for this community. Link is in the description. Join up because this stuff moves fast. Now let's begin where the pressure's building, because markets don't lie when it comes to pain. Overnight, the headline wasn't just about silver. The headline was that Shanghai's physical silver price surged to an all-time high, and the gap between it and the US spot price exploded into the kind of premium that makes you blink. Think about what that tells us. It means buyers over there weren't bargaining. They weren't hesitating. They weren't saying, let's wait for a dip. They were placing bids for real metal right then and shelling out serious premiums to secure it. That's not a trend line. It's not a mood. It's stressful. Because if the paper price truly reflected real-world supply and demand, that kind of spread couldn't last. Arbitrage would kick in, supply would shift, prices would converge. That's the theory. But this isn't a textbook moment. This is a reality where the East is scrambling for real goods, and the West has leaned on paper pricing for so long that physical and paper markets now act like strangers. Keep that idea close, because it's the thread that connects the entire picture. Now take a breath and zoom out for a second. I know it sounds wild, but spot silver is hovering near the $90 mark. And here's the kicker. A year ago, it was sitting under 30. That's not hype. That's not some rumor. It's the kind of price shift that can make rational people lose control, because huge moves stir up huge emotions. So here's a line that might be the most valuable thing you hear today. Never let emotions steer what you do next. Ever. I'm not here to tell you what to buy or sell. I'm not your financial planner. But I'll say this. Letting euphoria from green candles or fear from a red one guide your moves is how good positions fall apart. Volatility is the toll you pay to stay in the game. And silver isn't a gentle ride. It's a rocket, and rockets shake. While we're on that note, I have a question for you, and I want your honest answer in the comments because it tells me where your mind's at. Do you think silver will hit $100 and pause, or do you think it rips past it and catches the world off guard? Drop your reply below. I read the comments, and it helps everyone here see the bigger picture. All right, back to the real puzzle. If silver's going vertical in the West and physical premiums are erupting in the East, why does it still feel like most people are asleep? A giant silver holder, someone who owns more metal than most could dream of, once said it like this: silver can explode, and still only a sliver of the world will notice. I agree. Walk into any room of 100 people, and maybe one has ever really questioned the monetary system. Maybe one has asked what happens when debt towers over trust. Maybe one understands why, for centuries, hard assets have been the fallback plan. Wild stuff. Now let's get into the first major catalyst, the physical disconnect. A few weeks back, many warned we might reach a point where the number flashing on a screen no longer tracks what it actually costs to buy silver. And right now, that warning looks a lot like a preview. Because when you see huge premiums in a major physical hub, here's what it means. The metal isn't where it needs to be, and the global pipeline can't just teleport it there. That's when paper promises start to feel brittle. That alone is big. But it gets crazier when you peek inside the Western trading pit. On a recent day, paper silver volume hit the hundreds of millions of ounces just in one session. Let that hit you. In 24 hours, traders moved as much paper silver as what the world physically mines in a whole year. And we're expected to believe that's price discovery? That that's just market depth? Really? If you've ever questioned why silver seems artificially suppressed, or why its moves often defy logic, this is your explanation. A derivatives market this large can simulate abundance, even when the physical metal is scarce. It can simulate calm while vaults quietly panic. And the moment the real-world market forces the paper price to face reality, you get explosive moves like this. Now, buried in all of this was a subtle shift that most will overlook. But I need you to catch it, because it's one of those quiet indicators that the system is under strain. The U.S. Mint just halted or paused sales of certain collector items due to volatile pricing. Translation: when input costs are moving rapidly and demand is hot, they don't want to sell a coin at a price that's outdated before the label finishes printing. This isn't some wild theory. It's logistical stress. It's what happens when orderly markets start misbehaving. A premium that wide is the market's way of shouting, screen price, delivery price. It's the gap between saying you have something and actually holding it in your palm. And if you haven't experienced that gap before, it's hard to understand why it matters. This is also why the price action feels weird. The paper price rises with hesitation, not conviction. You'll see jagged uptrends, random smackdowns that feel like someone took a mallet to the chart. Then, slowly, it climbs again, as if pulled upward by invisible tension. That's the signature of conflict between liquid bets and physical shortage. And if you've noticed strange intraday behavior lately, sharp dumps, quick rebounds, whiplash moves, don't brush it off. That's pressure showing its face. It's not elegant because the market's trying to juggle two conflicting realities at once. Now let's zoom in on a critical moment. One major institutional desk that had bet against silver recently had to cover losses after price broke technical resistance. You don't need the name to get the takeaway. Shorting means borrowing belief. And when price rips the other way, your broker doesn't care about your thesis. They care about exposure, so they shut you down. That means forced buying into a rising market. And in a tight supply zone, forced buying creates vertical acceleration. That's why they call it getting your face ripped off. It's not just defeat, it's humiliation. Now let's layer in another shift. This one is narrative-based. If you've been listening, you've probably felt it. For years, financial media treated gold and silver like outdated toys. They'd laugh, why hold metal when you could own productive paper? But lately, major funds and global institutions have been floating ideas that used to be taboo, allocating real weight to metals in portfolios, not token amounts, not 1%, substantial slices. And even if only a few big players follow through, the scale can overwhelm a small market. This is why size matters. In precious metals, even minor portfolio adjustments can lead to seismic price impacts. Now, circling back to that paper volume stat, it deserves a sharper lens. When close to 1 billion ounces of silver trades in one day on paper, what's really being exchanged isn't metal, it's claims, like shuffling warehouse receipts. And that works, until it doesn't, because receipts rely on faith. The faith that if you show up to redeem, the metal's there. The moment people doubt that, everything changes. That's when you start hearing soft warnings, delivery stress, delayed shipment, cash settlement. All polite ways of saying something simple, not enough metal at that price. I'm not saying the system will crash tomorrow. I'm saying it grows more delicate the longer it floats on synthetic volume, and fragility is what sets the stage for extreme price action. So, let's shift to something actionable. What can you actually do with this knowledge? First, if you own physical silver, know exactly where it is, how it's secured, and who could access it. No joke. That threat inside your house comment, it's not just humor. It points to a real flaw. People accumulate, but rarely build a real plan. So ask yourself now, is your stack a legacy asset? A personal hedge? Is it assigned to a purpose? Decide that before headlines spike demand, because interest always follows price. Second, if you're eyeing mining stocks, treat them for what they are. Businesses, not metal. They have CEOs, balance sheets, political landmines, and dilution risks. If you're stepping into that arena, stay sharp. Third, if you're just watching from the sidelines, don't let velocity overwhelm you. Big rallies can be intimidating, but no market moves in a straight line forever. They inhale. They shake off the weak hands. They reset. Your job is to keep learning, not to chase highs. And finally, Here's the next cliffhanger to watch. It's the question that determines whether this is just a spike or the beginning of something deeper. What happens when the public steps in? Right now, most buying is from institutions, regions, or people who've done the homework. But retail behaves differently. Retail is impulsive. Retail reacts to headlines. Retail buys from fear of missing out. And when that hits a market with shallow inventory, it doesn't create stable price action. It creates chaos. You get price gaps. You get dry shelves. You get digital sold-out signs. So don't just track price. Watch availability. If you start hearing the same reports, bare shelves, shipment delays, fewer options, that's your clue the market is shifting from pricing to rationing. And when rationing begins, things escalate quickly. Now, there's one more reason those big gold price moves matter for silver. If gold revalues, then the gold-silver ratio becomes the real battlefield. If that ratio narrows, silver gets rocket fuel. If it stays wide, gold takes the lead. Either way, the entire metals sector remains in play, and that's critical for producers, hedgers, and anyone trying to shield their buying power. Let's close this out with the most essential piece. This isn't only about where we're headed next, it's about the broader world we're entering. A world where printing money is routine, a world where debt is managed by inflation, a world where supply chains become chess pieces, a world where raw materials are redefined as assets of power. In that kind of world, metals don't sit on the fringe. They move to the center. That shift isn't temporary. It starts shaping how people think. It changes how capital is deployed. And once that happens, the runway stretches long. Now, before I go deeper, let me share a creative side note since a lot of you ask. If you enjoy real-world silver wins, stories from people stacking with purpose, and the mindset that helped them, I've set up a separate channel just for that. The link is in the description. Go subscribe there too if you need motivation when things get volatile. Okay, back to the core thread. Everyone keeps treating $100 silver like it's some mystical ceiling. You keep hearing the same forecast. Silver hits 100, then drops. Maybe, or maybe not. One thing I've learned from following markets, what everyone expects rarely plays out as predicted. Sometimes the price halts right on the number just to shake up the crowd. Other times, it smashes right through it just to prove the crowd wrong. So forget worshiping price targets. Focus on the pressure points. Pressure drives price more than sentiment ever will. And right now, that pressure includes rising physical premiums, persistent demand, and a paper market that's clearly unstable. That's why some analysts believe the move might not just continue, it could accelerate beyond what most are ready for. And that's also why short sellers, especially the late, overconfident ones, tend to get wrecked. When a crowded position collapses, it doesn't exit quietly. It breaks hard. Now let's pivot to something lighter, but no less real. There's a running joke in the metals community that goes like this. When silver's cheap, your spouse thinks you're crazy. When it starts climbing, suddenly it's our silver. And when it goes vertical, it becomes my silver. So yes, behind the humor is a warning. Your biggest threat might not be the banks or funds. It could be the person upstairs who just discovered a spiritual bond with your stash. Laugh now, but make a plan. And while we're talking plans, here's a quick question for you. Drop your answer in the comments. If the gold-silver ratio collapses, would you trade some silver for gold? Or are you holding silver through the endgame? No judgment, just clarity. Now let's touch on gold itself. Silver may be stealing headlines, but gold remains the anchor under all of this. One global asset manager recently ran a simulation that shocked even seasoned investors. They asked, if gold were required to back today's money supply like it did under older standards, what would its fair price be? The results weren't modest. If gold backed the monetary base, the implied price was in the tens of thousands. If it backed all circulating money, the figures were astronomical, at least until you consider how much fiat has been created in recent decades. I'm not saying gold hits those numbers tomorrow. What I am saying is this. Those estimates highlight the staggering disconnect between paper wealth and real assets. And once you grasp that gap, you realize precious metals don't need hype. They just need time. Now let's get into the mining stocks, because this is where people get confused. They see silver trading near $90, then look at silver miners and wonder why the stocks aren't exploding. It's a valid question. Because miners offer leveraged upside. When metals rise, earnings can grow faster if costs stay stable. Here's a way to picture it. If a company produces at $20 and sells silver at $30, it makes $10 per ounce. If silver hits $60 and costs stay the same, profit jumps to $40. Price doubled, profit margin quadrupled. That's the upside and the risk of leverage. So why the lag? Because markets move in steps. Investors wait. Big funds shift slowly. And those who miss the initial physical rally often hesitate to chase mining equities. But here's the real pivot point. Once quarterly earnings start showing actual cash flow gains, everything changes. The capital starts flowing in, the spotlight turns on. And once the capital begins pouring in, mining stocks can accelerate like they're tied to a rocket engine. That doesn't mean every name in the space will perform. Some are run poorly, some are drowning in dilution, others are exposed to high-risk regions. That's reality. But as a group, when metals surge, miners can flip from forgotten to front page in a flash. And here's something worth remembering. There's a key difference between gold and silver mining benchmarks. The major gold miner index has already broken past its old highs. Silver miners, on the other hand, are still trailing previous peaks. That gap draws attention because when silver starts pressing major resistance again and again, those lagging stocks can catch fire and the skeptics who bet against them often get run over. Now, let's connect all the dots with the bigger forces, the ones that don't care how you feel. First, China. There's rising speculation that China has reactivated large-scale stimulus measures, pumping serious liquidity into its economy. Whether you call it easing, stimulus, or another acronym, the outcome is the same. More money, more lending, more real asset demand. And the figures coming out of China's monetary expansion are staggering. In fact, by some estimates, their broad money supply, measured in USD terms, now exceeds that of the US. And here's where it ties into metals. When a nation floods its system with currency while simultaneously prioritizing hard assets, it creates a long-lasting demand engine. That engine doesn't stay contained. It spreads into global markets. Second, the West. There are whispers, some credible, some exaggerated, that a small group of major Western institutions hold enormous silver short positions via derivatives. Whether the exact size is perfect isn't the issue. The issue is this: if the short interest is massive and physical supply is tight, there's risk on the table. And that risk has a name, a squeeze. Not a fantasy born on social media, but the real kind, where contractual obligations collide with physical scarcity, where traders who bet wrong are forced to buy into strength. If that's even partly true, it helps explain the speed and force of the recent move. Third, geopolitics. This is where the decade-long thesis begins to show its face. Look around. Wars, trade barriers, currency disputes, energy rivalries, national resource hoarding, alliances shifting, supply chains rewired overnight. The global landscape is not stabilizing, it's fracturing. And when uncertainty rises, governments and institutions favor assets that exist beyond someone else's promise. That's a lesson as old as central banking. It's why gold remains relevant. And it's why silver, with its unique blend of industrial utility and monetary roots, can suddenly become a choke point. Fourth, debt. Global debt has hit levels that dwarf prior eras. And when debt outpaces productivity, the usual response isn't repayment. It's currency expansion, yield suppression, and behind-the-curtain wealth transfers. That's not a hot take. That's how systems cope when cornered. Which brings us back to you, the individual, because it's easy to get lost in global forces and forget the practical side. If you own metals, your biggest test isn't understanding the case. It's controlling your reactions, because this market will toy with your emotions. One day you'll feel unstoppable. The next, you'll question everything. The winners aren't the loudest. They're the ones who stayed disciplined. And while this community grows, I want to ask you something real. Think about a win you've had. It could be in business, life, investing, or even sticking to a goal when it got hard. Drop one lesson from that experience in the comments. Someone out there might need it more than you know. Now let's talk timing, because everyone wants dates. People keep asking, is this it? Is this the top? Is the run over? The honest answer? No one knows the exact turn. But here's what we can observe. Physical premiums signal tightness. Derivative volume signals distortion. Big money is sniffing around. and money printing isn't taking a break. So the better question isn't, will silver go up forever? It's, what do healthy pullbacks look like during a long-term repricing? Because in a real repricing, dips are opportunities for some and traps for others. And now I want to do something financial news almost never does. Zoom out and speak clearly about risk. Yes, metals pull back. Yes, they're volatile. And yes, mining stocks can swing even more violently. But the reason long-term holders stay the course isn't because they expect a smooth ride. It's because they don't trust that paper assets alone will hold real value over decades. It's because they want something that isn't someone else's IOU. Finally, let me address what's happening behind the curtain. My channel stats show that a huge number of viewers aren't subscribed. I get it. Maybe you've been busy, maybe you forgot, maybe you're still watching from the sidelines. But if you believe in what we're building, take 2 seconds, subscribe now, and drop OG John AG in the comments so I know you're part of the core group. Also, don't forget, by the time you're watching this, a members-only deep dive should already be live. It's one full breakdown video where I go even deeper than what I can share here on YouTube. If you want all the layers in one place, join the membership and I'll see you there. That's where I share deeper breakdowns for the people truly tuned into this journey. Now let's return to the chart, because there's a psychological trap hiding in plain sight. When silver jumps from under $30 to nearly $90 in a single year, the mind starts to short circuit. First, it assumes a correction is due, because nothing climbs forever. Second, it starts fantasizing. What if this never stops? Both mindsets can wreck your strategy. The healthier mindset is simpler. Know the thesis, know your time horizon, and know your strategy, because if you don't have one, the market will make one for you, and you probably won't like the result. So here's what's really unfolding, laid out clean. Physical supply is under strain in key markets. The paper market is still trying to dictate price. Big players, institutions, and private capital are paying attention. Major firms are publishing models showing how tiny gold is compared to today's financial system. Miners are sitting on the potential for massive earnings if prices hold near these levels. Macro tailwinds, China's liquidity, Western paper shorts, geopolitical risks, and the debt overhang are all structural, not seasonal. So if someone asks, can this run keep going for years? The answer is yes, because the pressure behind it is baked into the system. Let's go back to that $100 level and the pullback narrative. If every trader on the planet expects a pause at that number, that expectation becomes fragile. Sometimes markets deliver the pause. Other times, they fake it, spiking just above before slamming lower to scare out the weak hands. And occasionally, they do the unthinkable, break straight through with force because the physical market is dragging the price higher, whether the paper traders like it or not. So don't cling to a number, cling to your process. Let me give you a grounded way to think about what's next. I can't predict the future, but I can give you 3 markers to watch. 1. Physical premiums. Keep an eye on physical price spreads in major buying regions. If those remain elevated, demand is still urgent. 2. Paper selling behavior. On strong days, observe how the price handles selling pressure. If it keeps climbing despite heavy volume, it means physical demand is overpowering synthetic supply. 3. Miners versus metal. If the mining stocks start catching up to silver itself, that's a sign broader capital is rotating into the sector, not just metal, but equities tied to production. Now let's tackle a strategy question I hear a lot when silver makes moves like this. Should I swap some silver for gold if the ratio compresses? That can be a smart play. If silver outruns gold significantly, some holders may want to rebalance. The goal isn't to crown one metal the winner forever. The goal is to use the gold-silver ratio as a tool, not as a feeling, but as always, it's personal. Your portfolio, your risk, your goals. There's no one-size-fits-all. Before we close, I want to reinforce something I keep seeing in this community. We are still early, maybe not early in price, but early in public awareness. Because once the average person catches on, the character of the market changes. It gets messy, it gets emotional. It turns into that phase where regular people show up to the store and see nothing left. And when that happens, the quiet stacking phase is over. This isn't fear-mongering. It's the historical cycle. When trust erodes, hard assets don't just rise, they disappear. And silver, in particular, is a smaller, thinner market than most realize. That's why it moves with speed. Now let's take one final breath and bring this back to you. The reason we build this community is because following markets like this can feel lonely. You start to wonder if you're the only one paying attention. You start to feel a little crazy, especially when the world insists everything is normal. Then silver moves like this, and suddenly you realize you weren't crazy, you were early. And being early doesn't feel good in real time. It only feels smart afterward. So here's what I'm asking from you. If this video helped you think more clearly, brought the story into focus, or gave you peace of mind, hit the like button. It matters more than most realize. That one click tells the algorithm to show this to someone else who might be feeling overwhelmed right now. Then subscribe if you haven't already. Join the WhatsApp channel for raw daily updates. And if you want the deeper, structured update, the members-only video is already live. It's where I cover everything in one shot, without the filter. Finally, I want to leave you with a challenge that fuels this comment section. Drop a success lesson you've learned in life. Business, discipline, investing, whatever. Someone else will benefit. And answer this. Are you expecting a steady climb from here, or a wild breakout that shocks the market? Let's see what the crowd is thinking.